Well, in today's lecture, I'm going to talk about capital asset pricing model. So, what exactly the capital asset pricing model? It is just an extension of the previously discussed Markowitz model, which is also known as the modern portfolio theory. So, let us see what does it tell, and we are about to discuss. Capital asset pricing model actually describes the relationship between the systematic risk, which is known as the beta, and the expected returns for assets, particularly the stocks. So, whenever we talked about and we mentioned the relationship between the beta as well as the expected return of an asset, which are normally the stocks or the shares. So this actually is being described in the capital asset pricing model. For an example, what are the elements so far as the CAPM is concerned? We have the risk-free rate, RF, and we have the systematic risk factor, which is known as beta, or you can say the sensitivity, or you can talk about the business risk as well as the financial risk, and the degree to which a company's equity returns vary with the returns of the overall market. So beta is something as a coefficient which measures the systematic risk factors of the particular stock related to the market portfolio. And the risk premium, of course. What is the risk premium? Let us take a look here what exactly we are meant this risk premium. So risk premium is actually defined as the expected return minus RF. This is a risk free. And how this is calculated, we will just take a look in a short while. So it can be described like this: ER. ER is the expected rate of return minus RF is known as the risk premium. So risk premium is especially related with the choices of the investors. Usually investors are by nature risk averse. Markowitz has defined about the perception of the investors that all the investors are rational. They want to reduce their risk, but they want to enhance their uh, internal rate of return from their investments in the stocks. Here, this is the equation. There, as I discussed, expected return is equal to RF plus beta, which is the coefficient of sensitivity or a systematic risk factor, or you can say that this is the overall market risk associated with the particular stock and the market portfolio or the total stocks. So this is a risk premium, as I said. It is known as here this expected rate of return from the market minus RF. ER expected return, RF risk-free return, beta is a market risk or sensitivity, or you can say the systematic risk factor, and ERM is the expected market return. So let us take a look what is beta and what is the significance of the beta. Let us take an example. If beta, for an example, is more than 1, for an example, it is mentioned here 1.3, and the market is expected to move up by 10%. So what does it mean and how significant the beta is? So it will be, if the overall market is moving up by 10% and the beta is 1.3%, so the stock is expected to move up by 13%, and vice versa. Vice versa means it is quite reverse also. For example, the beta is 1.3 and the market is expected to move down by 10%. So the stock uh, tendency is likely to move down by 1.3 multiplied by 10, that is 13%. So beta is the key factor used in the capital asset pricing model, which is a model that measures the return of a stock. So this is not merely a discussion about the CAPM. From the CAPM, there are other two theories which are known as arbitrage pricing theory And of course, as Markowitz discussed earlier, this is a theory of the capital asset pricing model given by the William Sharpe. But before that, Markowitz gave one model, and Markowitz is the base model. And after there are certain modifications because Markowitz discussed about the expected return and the standard deviation, total risk factors. And he did not talk about the beta, which is a systematic risk factor. And relatively, when the William Sharpe gave this model in 1960, so he gave an importance and significance of the beta, which is known as the systematic risk factor. So there are the systematic risk and the unsystematic risk. Systematic risk is controllable. Systematic risk is uncontrollable by nature, and the unsystematic risk is by nature controllable. So we will just discuss the capital market line and the security market line as per the beta and the standard deviation and how the beta is measured and calculated. So we will take a look in another video. But in this video, the motive was to discuss about the capital asset pricing model and the equation of the CAPM. Thank you very much.